Ladies and gentlemen, welcome to another episode of Échale Podcast. My name is Jose Quintero, and if you're listening to this just by the title of it, you'll know that today we're going to be discussing taxes, tax strategies, and I'm so excited for this episode just because I'm having a really close friend, a fraternity brother. In the fraternity, we call each other like padrinos. So he's my padrino in the fraternity, and he's also a CPA, has his own business with Caesar, who we formerly had a podcast called Salud Podcast, and it's G&G Associates. So I'm excited to welcome to this podcast, Rafa Garcia. What's up, brother?
Hey, how's it going, everybody? What's up, Jose?
What's up? Are you excited? This is your first podcast, huh?
Yeah, first podcast ever. Kind of nervous, but hey,
I'm
excited.
You're nervous. Tú tranquilo, yo nervioso, güey. Tú tranquilo y yo nervioso, que yo aquí voy a hacer las preguntas y las preguntas are about money and taxes, and you're good at that. First of all, I want to go ahead and congratulate you on completing your CPA, porque eso no mucho lo hacen.
Oh, yeah, no, yeah, thank you. Yeah, it's actually been a year since I passed everything. Well, last December, I remember, December 16th. Never forget.
Oh, wow, a year.
Yeah,
it's like you were born again, huh?
Oh, yeah, I still remember I was in Costa Rica, and I just put up the score. It was like 2 a.m. at that time over there. I was like, let me check. I think I ended up being like a 96. I was like, yep, I'm done.
That's awesome. Oye, well, let's go ahead and start talking about taxes, porque yo sé que mucha gente is probably like, oye, ya, churro con cómo lo conociste. I already told everybody like how we met in the fraternity, Casa San Bernardino, Sigma Lambda Beta. What up? Pero you obviously are, you started doing taxes as soon as you graduated, right?
Oh, yeah. I think I started in 2015 or 16 because I started doing VITE. I remember we had to do tax returns for free by paper too back in I wasn't even that old, 7 years ago, but they wanted us to do them on paper and stuff just to get to know all the process and stuff, which actually did help me a lot because I mean, at that time, I hated tax. I hated it with a passion. Like, I wanted to do accounting except tax. But,
Exactly.
I mean, yeah, eventually, I remember I took some tax course. It was my first D ever in college. I hated it.
Damn.
And
on taxes?
Yeah, it was a tax class. And it was my first D ever in college. And I was like, oh, man, I mean, it sucks. I got so mad that after that, I just started studying it so hard. Like, I remember it was a winter quarter I took it, I failed it, and then after that it's like you get 1 week of spring break. I remember instead of celebrating my spring break, taking a rest, I just started studying the book. So like basically all that whole week, then when I came back, I feel like I got so good at it. I'm like, maybe I can do something with this. So there, after that, I just started kind of building my craft, and from there, just all taxes.
Yeah, you know what? I admire you so much just because I was a business major too in college. Yet taxing and finance and accounting was not something I was very strong at. Even though like I've taken calculus and I passed those classes, taxes is a whole different a giant, because you have to understand the tax law to a certain extent in order to find these loopholes. So talking about these loopholes, I want to understand how come we're having so many rich people like continue to be rich, and we have like Trump, we have Jeff Bezos, we have Elon Musk who aren't really paying taxes, and we're like, what the fuck? They ain't paying taxes. What are they doing that we're not?
Like I always tell people, it's hard to people don't really understand it. But yeah, for me, the most literally the biggest tax loophole that a lot of people don't do, and it's one simple thing: is tax planning.
Wow.
That's the biggest difference of why the rich don't pay taxes and why basically not the middle class or anything, but it's basically all tax planning. Like these rich people, these large corporations, I mean, you think about it, they're tax planning like 5 years from now, like major rich people, you talk to them, they probably they know what they're going to pay on taxes for the next 5 years, as opposed to us middle class, like when you're in the middle class you just go and get your tax return and that's it, you go to your accountant, your tax preparer at the end of the year, here's my stuff. And that's it, as opposed to like start tax planning since the beginning, since like, since January, the first quarter of the year. Then after that, the second quarter, that's the biggest thing. I think that's the biggest reason why all these rich people don't pay taxes, it's because they tax plan, and
Yeah.
so that's what they practically what you do, just tax plans to the beginning. And they basically, I mean, let's face it, taxes is like one of the biggest expenses, right? Like we don't
Mm.
probably realize it, but like every time you make a dollar, let's keep
Uncle
it
Sam
simple.
wants some.
Uncle Sam wants 20% of whatever tax bracket you are. Whatever you make, $1,000. Uncle Sam's already like they're your silent partner all the time.
Yeah, Uncle Sam.
I know, yeah. So
Yeah.
it's like if it's one of your biggest expenses, I think in order to like try to save taxes or not avoid them, of course, but like legally
Mm.
a strategic plan is like every time you make some kind of financial decision, always look at the tax consequence, so
Mhm.
that I think that's the biggest difference. Like every time like a rich person or like those corporations, before like they make a major purchase, they kind of see like how is this going to benefit me tax wise too. They have that behind their mind. As opposed to like when we're not educated in that sense. We just basically make money, make money, make money. The year comes, your accountants are like, oh, sorry, you owe this much money. And you're like, oh man, because you were never
So,
prepared for it.
of course. I've been hearing a lot of podcasts, and I think this is the year that I'm being more financially aware of what's going on. Actually listening to money podcasts that you recommended, reading books about tax strategy, even though like I feel like I'm hitting a wall because I don't understand it. But I feel like if I continue to immerse myself in conversations about money, I'll eventually get it. And if I need help understanding it, obviously I have you, I have different people within my network that can explain it. But I want to go ahead and break it down for the average person, just because when we're talking about the average person who has a 9 to 5 job, they're on something that is called a W-2, which is what they get at the end of their year right? Is it a W-2, right?
Correct. Yeah,
Yeah,
W2.
yeah, which is what at the end of the year they get like their W-2 form, which at the time of the release right now, everybody at the time of the release, it is like mid-February. We're recording this February 2nd, and by January 31st, if I'm not mistaken, companies should have sent out the W-2 forms, right?
Correct. Yeah, legally they have to send it by the 31st. So you got that right.
I'm, dude, I am like, I'm telling you, I'm like on my tax level right now. So by the 31st, they sent it out. By the time this is out, hopefully you've received your W-2 forms already. And that's all you go and you talk to your accountant. Now, when I sit down with you, and I'm going to use me as an example in a lot of this, and you just kind of walk us through. When I go to you and you tell me, well, I'm only showing you one piece of paper, right? That's all my W-2. And the tax code or tax law or this government doesn't favor people with just a regular 9 to 5 job versus a business owner, a corporation. Why is that?
Okay, yeah. So yeah, definitely. That's it. It always the tax law always favors the businesses and investors, right? Let's face it, that's true. That's why like you always people get all Donald Trump doesn't pay taxes, this and this. Like, yeah, they always favor the businesses and also the investors because let's face it. Okay, let's be honest with it. Like when you're a W-2, you go, you work, that's it, right? I mean, you work, you do a good job at your job. But let's just say you get fired, right? Oh man, you get fired, apply for unemployment, and then you can go find another job, right? You don't really lose much. I mean, yeah, it's gonna be tough on you for the few months, as opposed to as a business owner. What happens if
Mm,
the business goes shuts down? What happens if the business something happens? Financially,
it affects way more people.
yeah, it affects employees. It affects you
Mm,
financially because now you're at a loss. Like yeah, you could probably get unemployment, but it's not gonna take care of all your losses you had. All the equipment that you lost, so depending what kind of business you are. Same goes with an investor. You go and invest money in a company right now. You let's just say you go to Apple and you invest all your life savings. I mean, which I don't advise just in one stock, but let's say you go ahead and do that. I mean, iPhones can start blowing up tomorrow, and there goes your investment. You lose all your money. So that's why the IRS, like the tax code tries to like, they give them the favor because of the risk they take. and not only because of the risk they're taking, but they're pretty much paying. They're in other words, they're providing to the community in different ways. You know, like a business. What do businesses do? They hire people. You know, they hire employees. You know, they create jobs for other people. You know, they basically make the economy, you know, spin a little bit better. Investors, what investors do? They invest their money. So when the companies get their money, what do they do with that money? They expand their business. You know, they hire more people. They buy more equipment. You know, like let's just say a big corporation buys millions, thousands of cars. You know, and they're employing thousands of people. So you know, they're helping other people. When they buy other equipment, other cars, they're actually helping another company grow, and then the other company. So it's kind of like a little circle that everything goes around and round. So that's what basically that's the psychology about behind it. You know, that why, you know, businesses get favored a little bit more. You know, because of, you know, they kind of like they that's how they provide to the society. So instead of paying taxes, that's how they, you know, they give to back to the economy, as opposed to when you're 9 to 5, you're just a W-2. I mean, yeah, you're doing a good job of your job, but that's about like, you know, you're not, that's, so the only way you can contribute to the economy is by paying your taxes, you know?
So,
So,
or what you're basically saying is the higher the risk, like having a company and investing, the more loopholes or tax deductions they're going to have versus a regular 9 to 5 employee when if they just lose their job, they have the benefit of getting unemployment. So the risk isn't as heavy.
oh yeah, that's one part of it, of course, you know, but I mean, the
Okay.
biggest part, yeah, like the biggest, like, let's just say, for example, you know, a corporation, right? Or a business, right? You're making money in your business. So now let's say at the end of the year, you know, the business is probably like, okay, I'm probably going to pay $3 million of taxes, right? So what they
Mm-hmm.
do is now like, okay, instead of paying those $3 million of taxes, what can we do? You know, there's credits that they're offer them right now. Like they can either buy equipment, you know, they can go ahead and buy millions, like not millions, but like thousands of car vehicles for their employees. You know, that's already a tax
Okay.
deduction, right? So now they purchase all those vehicles. Now that reduces their taxes. Why? Because they purchase vehicles, right? That's a deduction.
Yeah.
And when they purchase those vehicles from another company, the other company benefits off it, right? Too. You know, then now they make money, and now they can provide more to the economy.
Okay. Yeah.
Or what a
Uh,
lot of oh yeah, what happened?
no, go ahead. Go ahead.
Oh yeah, sorry.
Like you're on the roll.
Yeah. Oh no, yeah. And there's another one too. It's like a big one of the biggest credits that like big corporations get. It's the qualified R&D, you know, research and development, you know? Like that's something like, let's just say Amazon. Amazon probably, let's just say they're projected to have a $50 million tax bill this coming year, right? Instead of paying that, what do? They go ahead and develop their business. You know, they research and develop other businesses, you know, so they can like grow their business more. But that's also a tax write off too, because the way the tax code sees it is like, okay, if they go ahead and create more another company, or they develop their company, they're going to hire more people. They're going to bring more employees in, which is going to help the economy in that way. If that makes any
Yeah.
sense, you know. And as far as when you're an employee, you know, like, I mean, I know they don't. I guess they don't see it like. I guess the only way you can provide to the economy is by paying your taxes. You know, so that's one of
Yeah.
the biggest difference. Not just about the risk, but it's basically just a contribution you make to the economy, and that's kind of how the tax system works, right, in the U.S.
So let's go ahead and use examples. And I want to use me as an example because I've always said I don't like gatekeeping information and gatekeeping like how to do this because it's all pretty fun and games when you're explaining it about big companies. But what about the average individual? So let's go ahead and use me as an example. When I started going to you, I just had my W-2s. At the time, I was doing a little bit of work photography. I think I remember talking to you, and I didn't have a DBA at the time, which we'll get into what a DBA is. So you had me do a Schedule C, right?
Correct. Yes.
Remember?
And
Okay, so what is something that a normal person can do to start itemizing or taking deductions for the average 9 to 5 person? What deductions can they take?
okay, yeah. So now, so like technically after 2017, they changed the whole tax code basically. Like before, you were able to write off some of your job expenses, things like that. But after 2017, basically from 2017 other to 2025, they removed all that, right? So now it was kind of like almost impossible to take any deductions. So what I always recommend people, if you're still in your 9 to 5, you're in your W-2. What I always recommend people is always start a side gig. Start a little small business. Like now, especially now, it's so easy to start a business. Especially with social media, like anything people say, you can sell anything, something with your passion. You can go ahead and start something, right? That's what I always recommend people, because when you start doing that, you can start using some of your personal expenses for the business. Like you can actually kind of like make them. Not saying you can go ahead and for example, like your cell phone, right? Cell phone right now is not deductible. Even if you're an employee, even if you use it for work, like unfortunately you can't deduct it, at least for federal. So now how can you try to find a way to go ahead and deduct that cell phone? Okay, let's go ahead and see if we can start a side gig. Let's just say you start selling food. You start delivering meal preps to people. So now it's like, okay, let me start selling some meal preps. Now you can go ahead and start, selling. Let's just say now you make 4 or 5,000 a year just on your side gig. Now you can write off at least half of your cell phone. If you use it for personal business, that's 50% business. Now you can write off your cell phone bill. That's something
So
that you can include that.
Would this be via Schedule C, or does it have to be in DBA, LLC, or can the ordinary 9 to 5 Joe do this and then be like, hey, I started this side gig? Is it a Schedule C, or do they actually have to legitimize their business?
No, you don't. Yeah, you don't need nothing to start your business. I mean, if you don't, basically you can just go ahead and start making money. You don't have to. You don't need any licenses. That's one of the biggest misconceptions I see all the time now. Like you see all these promoters like start your LLC to start a business, like things like that. Like I mean, it'll be nice to have an LLC for legal purposes, which that's a whole different thing we can talk about another time. But you don't need an LLC or corporation or any licenses to start a business. All you do is start working. Of course, make sure you have the proper licensing. Like for food, if you're gonna sell food, I'm sure there's you have to go ahead and get some food license and all that. But as far as taxes go, like the IRS doesn't care what you do as long as you pay your taxes. So what you'll do if you start making some money, you report on your Schedule C. You go to your tax preparer, your accountant. Hey, I started making this side gig, and from there, they report on your Schedule C. $5,000 that you made, and from there you start writing off all your expenses, so you can write off your cell phone bill, some of your car mileage, Hey, even traveling, I know that's something you're doing a lot too, now you're trying to use your business to travel, right? Now, even though you're probably using it for pleasure and business, but if you combine both of them, now you're taking advantage of both of them.
Yeah. So I wanted to get into that. So what would be the difference between a Schedule C? So Schedule C, for anybody listening, is when you go to your tax person or tax preparer and you said, hey, I have a side gig. They're going to, for the most part, if this person knows about taxes, there's going to be like, oh, let's do a Schedule C. So you can actually report your earnings and then start deducting based on the expenses that you've done. And then the next step, would it be a DBA? So for example, I'm a DBA right now. I'm not officially an LLC. Would I have to still do a Schedule C because now I have a DBA is doing business as, so like I have a business, I got my own EIN number. I have a business account now. So I guess I took it to the next level.
Yeah. So a DBA, it's practically a doing business as thing, right? That's just, like you don't need it to start a business, which at the end of the day, I always advise it because it makes you look more legit, instead of using like your personal name, like Jose Quintero. Now you can use Echale podcast or whatever, it sounds more legit. And then you have your EIN number. So now with that EIN, you can actually go open a business bank account and you can separate. That's what I always recommend. Like if you want to go through the side gig or start a small business, I always recommend just having its own business bank account. Why? It's easier to keep track of your expenses, and it always keeps you motivated. You know where the money's going, because if you start a business and you're just commingling everything like personal business, you're never going to see your account grow. You're going to be like, I'm doing all this work, but I rarely spend the money. It's better to keep it in a separate account and make sure you pay yourself just so it feels good. And what I would recommend, when you're starting a business, for me, it's always the most, not my thing is always create the name first. why
Yeah.
it motivates you. You know, you have something to aim for and something to visualize. You know, like Echela podcast, you know, motivates, you know, instead of like just starting a
Yeah.
business and not having a name, you're like, you know, I think it's just better, like something
So
a go to strive through, basically.
so technically, I will still have to do a Schedule C when I meet with you in a couple weeks.
Correct, yeah, because you're not incorporated. So
Got it.
even if you started an LLC, right? Even let's just say you want to go through the LLC, you know, you get an LLC, which the LLC, I'll just go briefly. That's just basically for legal purposes. It doesn't change your taxes. You can go ahead and if you create an LLC, you'll still file like if you didn't have anything. You'll file on your
Mm,
Schedule C because an LLC is
mm,
just basically for legal purposes, you know. Which if they sue you, they can only sue anything within the LLC if you maintain it correctly, of course.
got it.
And now, if let's just say you're an LLC and you know you can elect to be taxed as an S corporation, which when
Got
you're
it.
an S corporation, that's a whole different. You know, you file a corporation, and that's a whole different other tax planning, which I can go all day and explain on that.
So I definitely want to go into like, having a business, and then we're also going to go ahead and talk to, just the things that you could do to strategize as an individual who doesn't have a business to 9 to 5, because I feel like that's how a lot of people don't have a business. So we'll get to that in a second. No se me desesperen, but I want to continue on with a DBA, because a DBA is something that you suggested for me, obviously to legitimize it, and obviously for an EIN number. And just to kind of explain, when you fill out your W-2 form for your work, or if you're doing as a consultant, as a side gig, when I have to do campaigns for certain brands, they send me a form because obviously they're going to want me to pay taxes on the money that they give me. So when you write down your name information, instead of writing your social security number, you're going to write your EIN number, which is the real benefit to having a DBA. And like you said, to open up your business account, just to separate everything.
Correct. Yeah. So like when you get your DBA, you get your EIN. So an EIN is like a social security for the business, right? So
Hmm.
now instead of giving out your people your personal social security and the name, now you just give them the EIN number. So
God.
that's one of the things I always recommend it, because I know like if you ever do some kind of like contract work or like any side gig, sometimes they want to ask for it. So instead of like you giving them like your social, there you go, just give them your EIN and your business name, you know, and you know
Got it.
it's for privacy purposes, and of course it always makes you look legit. Even if you're like, let's just say you're paying somebody, wouldn't you like it wouldn't look more legit if it's like a business name with a EIN? You'll be like, oh, this guy, like, you probably can even charge more, you know, because they think you're like
Yeah.
legit, you know.
Yeah. So let's go ahead and kind of give people an explanation and an overview of how somebody who has a business would start deducting to not really pay taxes. And I'm going to use me as an example. Like I mentioned before, I don't like to gatekeep. So I'm going to be completely honest with how much money I made just doing podcasting this past year. So, I mean, Rafa, how much did I do? Because you do my bookkeeping.
Oh, okay,
Let's
all
just give an
right.
estimate number. I mean, I'm going to be completely honest with people. How much did I do? And this is including podcasting and also side gigs that I've done with like campaigns with other brands, because obviously that helps. But how much did I make? And then we'll start seeing what I've been deducting.
Okay, perfect. So I think based on like, when I checked your gross, I think you were like at 32, 30 on or about gross,
$32,000, yeah.
30 gross.
32,000. So, amen. God is great. But imagine trying to pay $32,000 in taxes.
Oh yeah, because like one thing, I mean, I won't go too much into detail, but like yeah, if you're a Schedule C, like you know, you're not incorporated. When you make, you know, self-employment income or, you know, side business, you pay something called self-employment tax. Self-employment tax is it's 15.3% of whatever
Uh-huh.
you make. So if you make 10K, automatically you have to pay 15% tax on that, on top of your other regular federal taxes, which technically that's self-employed in income, is basically just social security, you know, like, you know, when you work as a W-2, you never get your full check. If you made $100, you don't get 100, you get like 92, because they take social security and medical, right? That's automatically, you can't get away with that. So that's why people do a corporation, because when you're making such high income as a business owner, you can avoid a certain amount by doing a corporation. So that's, like I said, that's a whole different ballgame. I can explain later, but
Yeah.
yeah.
So out of the $32,000, if I was not writing anything off, how much would I have to pay in taxes?
Automatically, I mean, I don't know my calculator. How people 30? Let's just say.
I have a
All
calculator.
right,
I
then
can calculate it right now. What do I have to do? I have
just
32,000 times what?
times just put evenly 15%.
15%. That's already $4,800.
That's
Wait, that's it? That's all?
Oh, no, that's not including your federal tax. I mean, federal tax, I mean,
Oh,
let's just say you're at the 24% bracket. Add another
uh,
24%.
to the 32, not to the whatever. Like, I don't subtract 32 minus 4,800, so it's out of the 32.
Out of the 32. Oh, yeah,
Okay, so
technically, yeah, subtract the 4,000 because you get a deduction too. So, yeah, subtract the 4,000 out of the 32 and then multiply it.
4,800. Okay, that's 27, and then multiply it by how much? 24?
Yeah, depends on the tax bracket, but let's just keep it at 24% right now.
So that's 6,528 plus the 4,800 in the beginning. So I'd have to technically pay $11,328 in taxes.
Correct. And
If I did it. Oh, there's more?
Oh, and the state taxes, California.
How much is California? Like, we're going to keep this even.
I think California's at, I think it's 9% the average. Just put 9%. Okay. Yeah, just keep it simple.
9% out of the 32 or 9% minus the 11,000?
Out of the 32 because, yeah, they don't deduct the self-employment, so.
Fuck. Okay. Pinche hijos de la chingada.
I know.
Okay, that's 2,800. And then let's just say it's 11,000. So I technically owe about $14,000 in taxes.
On or about. On those, yeah, okay. It's almost, yeah.
That's like half. That's like 50%.
Yeah, exactly, and that's basically because of the self-employment, though. That's the thing that like kills because, you know, you can't get. I mean, by doing an S corporation, that's when you can go ahead and try to avoid some of it, of course, you know, because you still have to pay yourself a reasonable salary when you're a S corporation. But hey, that's like,
it can get a little bit more complicated.
Yeah, that's why you have to tax plan, you know, because let's just say you're doing that for the, you know, years and years and you never tax plan, you're going to be paying that amount for the rest of, and you know, like years. I know people that have been making super good money with their businesses, but when they came to me, I'm like, dude, what have you, you know, oh, nobody ever told me, you know. And now it's like if we can save you $4,000 or $5,000 in taxes each year, imagine in 5 years that's $25,000. You know, 10 years that's $50,000 in taxes just by doing one simple tax plan. You know.
Yeah. So last year, that's when I obviously you've done my taxes for the past 5-6 years. But when I asked you, hey, I want to get serious about starting a business, I actually want to charge for this. I'm starting to get like campaigns here left and right. Obviously, praise God for these opportunities. I asked you in the middle of the year, I need your help. And because I want to legitimize this, I know about taxes, but I don't know as much about taxes as you do. So help me start planning. So you got me on QuickBooks, which is an application. You told me anything that you do, take a picture of like the receipt, write in the receipt who you met and what you discussed. Take a picture and upload it to QuickBooks. And obviously with the credit card that you linked, and it's like a business credit card or business debit card, then it automatically syncs in. Like it looks at the transaction and it syncs it, right? So that way, if I ever get audited, there's proof.
Correct. Yeah, because one thing that I always recommend, it's like, yeah, if you start your business or you're starting your side gig and you want to start writing things off, always make sure you have this documents to, you know, prove that the expenses, you know, receipts, because yeah, you don't want to start deducting all these things and then you get audited and you're like, man, you don't have anything, then IRS takes it away, plus they penalize you. So always save documentation, you know, which is a picture, whatever it is, always save it, you know. And if you're gonna go have a meal with somebody to make it, you know, which is a tax deduction if it's a business meal meeting, you have to write, yeah, who was it, what was the business purpose of it, and save the receipt, and that should be pretty solid.
Yeah. Okay, so now I started writing things off as of last year, mid-year. What things was I writing off, and can I write off in order to decrease that?
Yeah, one thing that I know, like for you, that you're benefiting of odds, you're writing off your travel expense, right? You've been going a lot to Mexico, Michoacan, which normally if you didn't have a business, that's not right. It's not a write-off because you're going for, you know, personal pleasure. But how about if you think like this? Okay, this is how the rich people, that's how like their tax planning works. How can I write off my trips? Now you start thinking, maybe I could go over there for a business purpose. Maybe I can interview somebody from like Michoacan, they can't come over here, right? So I have
Hmm.
to go to them, right? So you have to go all the way up there to interview them, right? That's part of your
Yeah.
business, your podcasting. They have to be there in person, right? So what do? So now let's start planning. Now your little trip, from to get over there, like your airfare, your Uber to get there, your meals while you're at the airport, all that becomes a write-off, right? Whether you spend $800, $500, that's $800 that you can write off those 30,000, and
Yeah.
that's something you were never able to do as a W-2 only, as an employee. You weren't able to take those deductions off. And that's how tax planning works, like you have to use the tax code to your advantage.
Yeah.
And like even goes with vehicles too, if you have a car, you use it for personal use, but hey, if you use it for business, now you can write a certain percentage of your vehicle, your mileage, whatever, but you're basically writing off expenses that you normally cannot do as a W-2 employee.
Yeah. And one of the things that this business has allowed me to do is help my family out. Because one of the things that I did last year was I hired my brother as an independent contractor to edit some of my videos or help me. The content that you see that I sometimes posted on Instagram, on TikTok, and that looks like cool videos, that's my brother who films me and edits the video. But instead of like saying, hey, bro, like, do this as a favor, it's like, no, I'm gonna hire you, I'm gonna pay you. One, because I want to help you out. Two, because I want people to know your worth. And if your own brother is paying you, I don't understand why you should be giving free stuff out to your friends, like, I get it whenever I said, but your own brother is paying you. Entonces I paid him an amount for his services. Obviously now he has to pay taxes on those, but it's a write-off off of me.
Now, yeah, correct. So now you write it off, but now, yeah, of course you have to report it in order to write off. You take that write off. Now he has to report that in his taxes. If you paid him 5K, for example, now he pays 5K on the taxes, and you get the write off.
Yeah.
Yeah,
And
and
then
then
if he has his own business, which I'm trying to make him do also, then he can start writing off stuff. Like the equipment that I'm recording on, the mixer, the mic, the cameras, the lights, this laptop that I just bought. It's all like I'm using it for business. Like you said, the travel. One of the things that people might have probably not been noticing, I actually have traveled to Michoacan a couple times during, like, already in this year. And because I went to record content over there, that's going to be airing later on in the year. But again, I took advantage and I saw my family. I took advantage because my grandma was sick, but I made it a business trip.
yeah,
You know?
yeah, no, and that also works too. Like I have a perfect example. I have a client. He's a little bit older already, but he has two sons, one in Texas and then one in Florida. And he came to me like 2 years ago. He's like, he's retired, he has money. So he's like, what can I do so I can, like, because he has to pay, of course, you have to pay tax on your retirement and all that. So what he did, I'm
Oh,
like, okay, let's see. You have a son in Texas. You have a son in Florida. How can you write? You go visit them at least twice a year, each one, right? How can you write that off? So we started thinking. He's like, have you ever thought of buying a rental property out there? He's like, oh yeah, I got the money, and I can use that investment. So what he did was he literally purchased a property in Texas, right? He's renting it as a rental. And then he also has one in Florida, also a rental. So technically, he goes and visits his son for, like, for holidays or whatever. So every time he flies to Texas, that's hardly a write off because he basically does it as travel to go maintain his property. He has to go take a look at it. He has to go ahead and see how it's doing, right? He's going for
mm-hmm.
personal, for business purposes, of course, but then he can also slip it in and go for, like, for pleasure as well. Like, I'm not going to go
Yeah.
into detail to make, like, there's a certain amount of time and percentage you have to take,
Yeah.
to make it deductible. But hey, if you fall in those guidelines, the IRS cannot deny you that deduction. And that's tax planning right there, thinking like that,
Yeah.
using, like, just sit down and think, talk to your accountant, talk to whoever does your taxes, to, start planning like this to see how you can benefit of all these strategies that pretty much, like the rich people, why they don't pay taxes. That's their way of thinking. That's how they think, like, I'm gonna buy a
Mm-hmm.
car next year. how can I strategize to be able to write off at least a percentage of it or the full car? Let's think, there's a loophole for that. It's in the tax code.
There's a loophole for a lot of things. There's tax codes for a lot of things. And that brings me to my next topic, because a lot of people are going to these, which is not bad, right? And they're mom and pop shops that offer tax services. But what would be the difference between what you offer with your clients as a CPA versus somebody who just does taxes, no sé, en su tiendita?
Mm-hmm. Yeah.
That aren't a CPA.
So the biggest difference, I mean, of course, like I do compliance. So technically, when you go file your tax return, like right now it's tax season in full effect right now. But when you go file your tax return, what do? You give them your documents, and they'll do your tax return. So they're basically practically just filing your tax return based on things you already done, right? Based on the income you already made, based on the expenses you already had. When you come down to the tax, little mom and pop's tax shop, or even me too, if you come to me like right now and I'm doing your tax return just to stay in compliance with IRS and just giving you the deductions that you're entitled to already, right?
Mm-hmm.
But what I do as a CPA, I go ahead and I can offer tax planning to you. If you come up to me, it's like, hey, Rafa, I want to save, on taxes, or what can we do? All right, let's sit down. Let's analyze your financial picture. Let's see how much you're making. What future plans do you have? Now we can create a tax plan. Like, how about you tell me, I want to buy a rental property next year. Okay, perfect. Let's see how much it's going to save you on taxes. What can you do to benefit off of it? Or, hey, I'm gonna buy perfect example. What happened last year? What did you do that saved you pretty much? You're paying zero taxes this year.
Oh my God, what did I do?
You called me like at 9 p.m. at night. It was on July, I think, something, when you purchased your vehicle, your electric vehicle.
Oh, I did. I purchased an electric vehicle, and I was like, I want to, because we started tax strategizing. And I think that's something that I really appreciate from you, because we've been meeting once a month, whether it be via Zoom or in person or over the phone, and just kind of like, hey, do you think I should purchase this? Can I purchase this? And, it's that reassurance. So when I said, like, I know I'm making this amount of money, I need something to offset my taxes. Well, I want to buy an electric vehicle. I don't know if it's the most financially savvy thing to do. And you said, well, you're going to get the electric tax credit. So that can offset about $7,500, which is the federal, and then $2,500, which is the state. And I'm like, oh, okay, now we're talking.
No, yeah, exactly. So let's just say you would have purchased the vehicle without knowing anything. You would have bought a gas vehicle. You would have came to me at the end of the year and been like, okay, I purchased this Toyota, $30,000. Unfortunately, you can't write it off. You don't have a business. You don't have nothing, so you can't write it off. But how about if you would have called me like 3 months in advance or like before the year end and be like, hey, I want to purchase a vehicle. Is there any benefit? I would have been like, not for a gas vehicle, but if you want to look at the electric vehicles, these vehicles offer the credit, and boom, 7,500 credit right there,
So I'm glad that you brought up the 3 months before and whatnot, because I'm pretty sure there's a lot of people. And again, if you're listening to this podcast, we're going to go ahead and talk about what you as an individual can do if you don't have a business to start writing things off. But right now we're talking on a larger scheme, because I do want to motivate you to open up a side gig, because así somos los latinos, emprendedores a la madre. But I wanted to go ahead and talk about those people who come at the end of the month, December, who are like, I need to start writing things off, and they literally have nothing. Because I'm sure you get that a lot. Like, how can I save taxes? And it's December 20th. And you're just like, oh, you want to start tax planning now.
Yeah, if you like in December, it's kind of like you're in a rough spot already, especially if you're like a W-2, you don't have nothing else. There's not really much you can do. I mean, maybe just contribute to like a traditional IRA, like some retirement account, which is like $6,000 the deduction, which is not too much. But yeah, if you come to me like in December, I mean, there's really much you can do. You can't even adjust your withholdings, It's only 1 week, 2 weeks left out of the year. So that's not really much you can do. But that's why I always recommend like tax plans since the first quarter, since starting March, mid-year, September. Like by September, if you start tax planning, you should already know how much you can owe. What can you do to reduce that, Like as a W-2, I mean, like I said, there might not be as much deduction as a business, but there's still ways to at least lower your taxes. Like if you have like a 401k at your job, You
Hmm.
can contribute this year. I think you can contribute up to 23,500. You know, I mean, if you have that kind of money, and
Yeah, I know.
like, go ahead and yeah, if you maximize your 401k, you know, if you, let's just say you're making $100,000 and you throw in 20,000 into your 401k, you're only going to get taxed on those 80,000, which is like a
Mm,
$4,000 tax savings. You know, if you do it for the next 5 years, you know, that's 20K
yeah.
saved in taxes. I mean, of course, you're going to pay that tax when you take it out, but there's other strategies that you can do to mitigate all those taxes. But you know, it's just talking to your accounting, you know, and getting to know you personally, you know, like see what's your
Yeah.
picture, what's your financial picture, you know, and getting that relationship and understanding that each other, that's how you start saving on taxes. You know,
Mhm.
you can start tax planning. Like right now, if you tell me I want to do this and this and this, I can start already breaking it down. Like what can we do to go ahead and save you on taxes, you know?
Yeah, and this is the first full year that I'm going to actually work with you, tax planning. Like we've already met for January, and now you're doing my bookkeeping, which is something that you do with QuickBooks. So what he does is oh, you go ahead. Like you're the accountant. So explica, what is bookkeeping?
No,
Yo acá
yeah.
nomás estoy diciendo.
No, yeah. So like what usually like I have a few clients that I offer tax planning with them, you know. So what I do is basically I run their books, you know. So I'm really analyzing all their basically every month. I check how much money they're making. Right, the first quarter comes, we're already projecting exactly about roughly how much you're going to make already at the end of the year, you know. So now we start kind of seeing how much you're going to make, and then we start seeing what kind of like what upcoming expenses are you gonna end up having, you know? Like let's just say right now I project you they're gonna make $60,000, you know, as a
Amen. Let's
business,
speak it
right?
into existence. Let's speak it into existence.
All right, perfect. So now we're like, oh man, you know, if you're going this rate based on your expenses, you're gonna net $40,000. So now what can we do? What's something that you've been wanting to do? And you tell me, oh, I've been wanting to buy a
Um,
rental property, you know. I don't know.
yes, there you go. I want to buy a rental property. I want to hire my mom. Um,
Yeah.
so like
So now I'm like, all right, you want
because
to buy
okay, so let
yeah.
me explain why like I'm over here like I want to hire my mom. My mom is unemployed. My dad is already retired. So that means they legitimately together since they together, they filed jointly together. How much do they have on tax deductions if they file jointly?
If they find jointly, I think I believe the standard deduction at 25,000 right now, 25,900 if I'm not mistaken.
Around there, 25,000.
Yeah.
So if I hire my mom and I have her work on my business, X, Y, and Z, and I pay her $10,000, how much taxes does she have to pay of those $10,000 if she has a 25,000 deduction?
Yeah, if since in that case, since it's under the 25,000, she won't pay any federal or state taxes. However, since like I said earlier, she's now self-employment income, so she has to just pay that 15% for to Social Security and Medicare, which is what, $1,500.
Imagine that. Like I employed my mom, gave her $10,000. She only has to pay 1,500 of those. Like what? I don't see like now I'm seeing the benefits on how I can help my family out
Oh yeah,
and whatnot.
yeah. And one thing that a lot of business people don't know, especially if you're listening to this and you have a small business and you're not incorporated, you're just like you know Schedule C, you can hire your kids. If they're under age 18 or under, you can actually hire your kids and not pay they don't have to pay that self-employment tax because they don't have to pay any FICA, which is federal Social Security and Medicaid. I mean, of
Mm.
course, run this by your accountant. I'm not advising anybody, but talk to your accountant, prepare. And if they're like 6 or they're under 18, of course, they have to do some kind of reasonable work, of course. You know, maybe they can model for you the social media or they can do, you know, paper shredding or whatever. As long as they're employed, you can go ahead and take that deduction. So you can pay them up to $12,000 depending on how the state you're in, their standard deduction. But if for federally purposes, as long as you pay them under 12,000, they don't even have to file a tax return. You can still claim it
Look
under the
at that.
dependent, and you're taking the deduction too. You know, so if you're making $30,000, you had a kid, you pay them 12K. That's already you take that 12K deduction. So now you're only paying tax on those 18,000.
And where am I putting those 12,000?
Well, those 12,000. I mean, what I recommend. I mean, I'll open a Roth IRA for them. You know, there's no age limit at Roth IRA, but hey, as long as they have earned income, which they already do because you're paying them under your business, you go ahead and throw that in the Roth IRA. 10, 20. I mean, if they hire them at 10 years old, in 8 years, that's your college fund right there, you know?
That's more than a college fund. Like, I mean, because if you look at interest rates, if you manage that Roth with certain stocks and whatnot. I want to go ahead into and talk about taxes for people who have stocks, because I feel like that was a lot of people at the start of 2022. But I want to go ahead and first start with the average 9 to 5 person. What can they deduct? School, charity, what are the deductions for a normal person that they can be like, hey, I want to deduct something, that way I don't have to pay that much taxes? What can they deduct?
As a 9 to 5 without, going into investments or any rental properties or business, what you can deduct is very limited, to be honest, especially like I said, after 2017, they raised the standard deductions, like for being single, they raised it up to almost 13,000. This 12,900, right?
Hmm.
No, normally you can write off your mortgage interest. If you're paying like a mortgage, you can write off the interest, the real estate taxes. But if that doesn't exceed your standard deduction of 12,000, very difficult for it to be beneficial, right? Because you can also
Uh,
write off your medical expenses, right? But your medical expenses have to be 7.5 above your AGI, your adjusted gross income, which it's almost, it's almost impossible to have. Only if you have like a major
so,
surgery, like a big medical expense, that's when it benefits you,
so
but it's very rare.
what you're saying is, if regular people from that get just a W-2, don't have a business, want to itemize, because that's what that is, they'd have to itemize more than the standard deduction. They'd have to be like, hey, I donated, let's say, to charity, 13,500. They're like, oh, okay, well, now we're going to deduct 13,500 from you, as opposed to, because it exceeded your typical 13,000 standard deduction.
Correct. Yeah. So like right now, the standard deduction at 12,900, right? Per se.
Okay.
So now in order to because the most important itemized deductions are mortgage interest, real estate taxes or personal taxes, and charitable contributions and medical expenses, right? Medical expenses are almost kind of hard to even take advantage because, it has to be above a certain percentage.
What about
However,
school?
school tuition, oh, that's something you can get a credit for going to school, like for
Oh, it's a
college.
credit.
Yeah,
Okay.
that's
Okay.
something else. Yeah. For itemized deductions, those are the most popular ones. So yeah, if those expenses do not exceed your standard deduction, then you might as well go with the standard deduction. So that's why now it's very, very hard, especially if you're married filing jointly, to
Mm.
pay $25,000 in like mortgage interest and taxes. As long as you have a big house, a big mansion or something, you're paying that much. Yeah, but
If you're already paying that much for a house, you probably have like some side of side gig, an accountant helping you. Like,
yeah,
there's no.
exactly. So it's almost like, I mean, I still do itemize deduction for a few people, but it's not as common as it before. So like back in the day, you were able to itemize your job expenses, like job
Mm.
supplies and all that,
For
but
like
they took
teachers.
that away. So now
Oh, so
it's
teachers can't itemize? Like teachers?
oh, teachers no. The only thing they
Ah,
get, which is kind of sad, but if you're like an educator, you work as a teacher, there is a buff that you can deduct up to $300 of like
wow.
supplies, which that you don't have to itemize for that. It's already like to your
As
adjusted
an
gross
educator.
income. So yeah, but I mean, it's like those $300 can get you probably back like $80 more, something, but it's not
Yeah.
as this
What
still
are
much
some
more.
credits
Some credits.
that like regular 9 to 5 people can get?
Oh yeah, for credit, yeah, for credit, there's a lot. So now for credits, I mean, of course, if you have children, you get a credit for your child. Credit for if you have daycare, if you pay daycare, there's another credit
Hmm.
for that as well. This year or now they actually, they're trying to go more green now. The government's trying to provide more benefits for people that try to go green. So now if you like electric vehicles, that's one big one that this year happened. That if you buy an electric vehicle, which if you do, just make sure it qualifies and you meet now they have income limits. Back then they
Mm.
didn't. Now they're starting to do income limits. So just make sure before you make that purchase, make sure you talk to an advisor to see if you actually qualify for it. But that's one big one. Any like electric, any solar things that you do to your home, like if you do solar panels, that's one big credit that you can get nowadays, like installation and all that. You can get like up to 30% of what you pay for that. minor little things for like, if you change your windows to be more green or like for energy purposes, there's a little bit credit for that.
Yeah.
What's another? Oh, tuition. If you pay tuition, you're going to school. That's one big one too. You can get a credit for going to school, which averages to like 2 to 4 thousand, depending on like what criteria you fit in. But that's another credit you can take advantage of nowadays. Hmm.
Well,
And yeah, I mean, there's a lot of credit. I can go on talking about credit. There's even credits I don't even know about yet. They have credits for
yeah.
everything, especially in
And that's what
businesses.
people get. Yeah, well, yeah, for businesses, I'm sure there's a lot of credits, but that's why people get like larger tax refunds. Where like, oh, okay, well, you get a credit for this, you get a credit for that, and it benefits like if you have kids. But then, how much does a kid cost? But
Oh
like,
yeah,
that's a whole
yeah. If you
different
want to add up the
story.
numbers, well, yeah, but yeah, I mean, yeah, they should be a little bit more, but $2,000, that's what they give you, unfortunately.
Mhm. Yeah. So now let's move over. And I want to reiterate for anybody listening, if you need any type of tax advice or consultant, if you have any question, I kid you not, Rafa is a great resource. And if he doesn't know, he will find out for you. Before we continue on, Rafa, where can they find you?
Oh, they can find me. So you can file. We have an Instagram page. It's called GGCPAs. That's one way you can find us there. Or you can also, we have a direct business phone number. You can always reach us at 909-340-0332. Or you can also send me a direct email, which is rgarcia@thegcpas.com.
Yes, and I'll make sure to put all that in the description below. But save that number. You never know when you're going to need it. And for people who are investing in stocks, because that became like a big thing. So capital gains, losses, tax loss harvesting, and then maybe dividend pays. How would that affect taxes? Let's go ahead and start with what is a capital gain?
Okay, perfect. So yeah, so see now that's for investing, which anybody can invest, right? Like you can open Robinhood, whatever your platform is, and start investing. So I mean, so technically a capital gain, it's basically when you sell some kind of asset, which can be real estate, which can be vehicles, whatever, like anything that's an asset. Like most popular ones are stocks, right? When you buy a stock, keep it simple. You buy a stock for X company at $5, right? You bought the stock for $5, and then in 2 years you end up selling that stock. So from $5 that you purchased it, the stock went up to let's say $10.
Mm-hmm.
You sell it in 2 years. Now what it's called a capital gain, right? Because you sold it at a gain, which is you made $5, right? Those $5 are not going to be taxed at your regular tax bracket that you are. So if you're at the 20% tax bracket, you're the 30% tax bracket, you're not going to use that because it's called a capital gain, long-term capital gain at least.
Mm-hmm.
That tax bracket, depending on what tax bracket you are, it's going to get taxed at either 0%, pay no taxes,
Wow.
15%, or 20%. So if you make under, like, I think right now it's like at 400,000, you're pretty much at the 15% bracket. Majority of
Wow.
people are at the 15. So instead of paying 20% or 25% on your regular bracket on those $5, you pay 15%, which is great, right? I mean, now we're talking about big numbers if you had a big capital gain, of course, but you actually get some kind of benefit. You pay a lower tax rate than ordinary income, which is, your W-2 income. So that's why, like I said earlier, I mentioned at the beginning, like, why are you getting some kind of like lower tax bracket? Why you pay less tax on those gains? Because of the risk that you put in there. You don't know what's going to happen. Your stock can go from zero. You can buy at $5 and go to zero and lose, all your money there. So that's why the tax code, gives you kind of a reward for keeping your money there, because now the company is actually using the money for something, and then you're actually taking some kind of risk on it too.
Yeah. So in December, we saw something, or we typically see something that is called tax loss harvesting, which basically means people start selling their stocks maybe at a loss, so at a lower price than they bought it, but to offset their taxes.
Yeah. So happen.
You took off your headphones. So Rafa is on a break right now.
They died. Like I think I'm
Your
still
AirPod.
right?
Oh, no worries. Yeah, I can still hear
All
you.
right, perfect. Yeah. Oh yeah. So tax harvesting. So yeah. So technically, like towards the end of the year, and that's one of the tax strategies I always advise people. Like usually around September, I start telling my clients like, hey, is there any stock that you know that you're at a loss and it's just not going to come back to life anymore? Like it's a done deal. Like either it was probably a startup company or something small, that you just for sure know it's not going to go ahead and go anywhere. What you can do is if you're to sell your stocks at a loss, right? They just say you sold a stock and you lost $5,000. Now those $5,000 you can actually use those to offset any other gains another stocks. So if you had another stock that you gained 10,000 and you have another stock that you lost 5,000, now you can use those 5,000 to offset the $10,000 gain. So now you only pay tax on those 5,000, right?
Can I offset these losses for my personal, I don't know, my personal W-2?
Oh yeah, definitely. Yeah. So if you don't have any other gains, so you had a $5,000 loss, but you don't have any other stock gains or anything, what happens is you can write off up to $3,000 towards your W-2 income. So now up to $3,000, and if you let's just say you had a $50,000 loss, you can write off only unfortunately to $3,000 that year. However, those losses don't go away; they carry forward forever. So you can it can help you offset any future capital gains, or you can just keep
God.
taking $3,000 towards so
So
it's done.
I, I explained it in the podcast episode where we talk about finances and stocks with Eddie. I think it was like 3 episodes ago, where we talk about where to invest your first $1,000. And I talked about how I bought about like $10,000 in crypto like a year and a half ago when it was like all booming, and I lost about $5,000 in crypto. So when December came, I'm like, you know what? I learned about this tax loss harvest, and I'm like, I'm going to offset potential taxes by just selling it at a $5,000 loss. And what you basically said, well, 3,000 you're going to use this year, maybe 2,000 next year.
Yeah, correct. So yeah, like you expect so right now you're gonna write off those 3,000 this year if you didn't have any other gains, and the other 2,000 either you're gonna offset any gains if you sell any good stocks at a gain, or you're just gonna take another loss, another $2,000 next year. So you get some kind of benefit, at least some reward for losing your money.
What about for dividends? A lot of people probably started buying stocks like Apple, and then they realize, hey, every 3 months or every month, I'm getting some money back in return. Do I get taxed off of that?
Yeah, so dividends are also taxed. So if yeah, there's something called qualified dividends. So most big company offer qualified dividends, which those qualified dividends also get taxed at the same tax rate as capital gains, which is the 0, 15, and 20. Which majority of the people are in the 15% bracket. I mean, for the capital gain. So any dividends that they're qualified, they'll go ahead and be at 15%. If they're not qualified, then you'll get taxed at your ordinary tax rate, which if you're at the 23% bracket, 24, then you're paying 24% on that. Yeah.
Okay. Man, there's so much more that I want to talk to you about, like, start tax planning as an individual, like what you can do as an HSA, credits to your advantage, an IRA, a Roth. But we're probably going to have to do another episode. Rafa, I want to go ahead and thank you for your time, because I feel like if you literally paid attention to this episode and if you stuck through it, Rafa gave you a wealth of knowledge and examples. And yeah, gracias.
Yeah, no problem. Yeah, there's a lot. The tax code, it's like I can literally go days and days just talking about, how you can strategize or what you can do. Either investing in stocks, investing in real estate, which real estate's another whole loophole that a lot of people, especially the rich, take advantage of. And then like even stocks too. I mean, we could probably set another episode and tell you how the rich don't pay tax with stocks and real estate. Because that's practically the biggest loophole in taxes is real estate,
and how they use other people's money to not pay taxes. anyways, me and Rafa have had these conversations, and you should be part of these conversations as well. Please, I ask, if you're listening, share this podcast so it reaches other people, not only so they can contact Rafa because he has a wealth of knowledge, and we as Latinos have to push each other and motivate each other and keep the money in the Latino community to empower the Latino community. So Rafa, once again, where can people contact you, find you on Instagram, send you an email?
Yeah, so you can follow us. We have a business on Instagram that's it's GG CPAs. And you can also give us a call, our direct number, which is 909-340-0332. And you can also email me directly at my direct email, which will be the rgarcia@theggcpas.com.
Thank you so much, Rafa, once again. If you have a specific question, or if you want Rafa and I, and especially Rafa, to answer this question on another episode, probably in the near future, please let me know on my Instagram account, whether it's my personal one at Jose Quintero TV or at the podcast one, which is Echale Podcast. Definitely would love to do another episode with Rafa. And if you have specific questions, it would really help. And we could be like, hey, fulanito de fulanita, ask this question. Let's go ahead and get Rafa's take on this. So once again, muchísimas gracias, Rafa. Until next episode. We're not leaving because I forgot to ask one of the most important questions of this podcast to Rafa, and we were talking about it off air. But I started this podcast, Échale Podcast, not necessarily por todas las ganas que le echamos como la comunidad latina, but what do you want to put in? What do you want to leave? What is your paw print, your mark on this society, world we live in, Rafa? What do you want to do with taxes and tax strategies?
Yeah, I wanted to offer it back to the Latino community, where I started from. I don't know if you remember when I was in Claremont, remember I had the little office right there? It was all Hispanics right now, it's like my mom and dad, all the little community that they always had bad advice from, the little income tax preparers and all that. And I always helped them out. And as I did my journey, got my enrolled agent license, got my CPA, my education, I always had a heart. They're still in my heart, I'm never going to forget it. And as I grew up as a professional, I realized that there's a big, big gap. CPAs want to always go for the big money. They want to go for the corporations, the rich, all that. But there's a big, big gap, in the middle, especially from the middle class down to, the lower income people. There's a big, big gap that I know they can actually use CPA services and they actually can benefit off of it. But there's nobody out there much, to offer those services. So that's my goal now. It's like I want to be that person, to help out, the Latino community, the low income community, or the middle class that just wants to go ahead and take advantage of all these strategies that supposedly the rich take, that the rich people don't pay taxes. Well, we can do that too, maybe not pay zero taxes, but we can get you to that level.
I'm fucking proud of you once again. Thank you, Rafa.
Okay, not a problem.